like Sam said, you still get all the appreciation, you get the debt pay down, you get cash flow still, you get the same cash flow as if you put 20% down, if you find this distressed house at a discount. So you get all these returns still without $1, without putting $1 in.
Hello and welcome to the FasterFreedom Show. My name is Sam.
And I'm Lucas.
And Lucas, we are celebrating today. Where's your champagne?
In your little thing there. What's that called? Stanley?
This
like
is a
knockoff
big
Stanley?
thing. It says Brewmate. This is the upper version of Stanley.
Oh, gotcha. Of course you would have that.
Look at this. It's magnetized. It's got a rubber top. It's got, it cleans easily. It's got a metal. So
Yeah, better than a normal cup, it looks like.
there you go. So anyways, we are celebrating our 200th episode today.
Yay!
Yay!
That's so fun.
At 100 episodes, you wrap.
Was it 100 or was it 50?
Was it 50?
When did you do your wrap?
Maybe it was 100, but episode 50, Lucas wrapped. At 100, I wrapped.
Yeah.
Oh, yeah, now we're 150, yeah. So, yeah, 100%, that was it, yes.
Yeah, we didn't do anything for 150.
No.
Yeah, we're kind of right in the middle of our transition, getting this new beautiful studio, and 200, unfortunately, we do not have a wrap for
But
you
I
guys.
promise you we will do a wrap at 250.
Yeah, that'll be fun. Like a duet, right?
Yeah,
Yeah, it'll be good.
we haven't done one of those since college.
Real estate. Boom. Maybe we'll make it on this topic that we're talking about today.
Today we're talking about the stock market versus real estate, the age-old battle of which is better. And honestly, some's better for certain situations, but I would say in my estimation, being a real estate investor, that about 80% of the time, depending on your current situation, real estate's going to be the best option. But we're going to get into that today.
Yeah, we are, and I think there are some pros of the stock market.
100%.
We can hit on those as well.
So the reason we're doing this is because the S&P fell 3% in one day, which is insane. The Dow Jones, this happened all on Monday, what would that be, the 4th? Monday the 5th. The 5th. I'm good at math. Monday the 5th. It was the biggest drop in a long time. It might not sound like a lot. S&P 3% down, Dow Jones 2.6, NASDAQ 3.4, but that was $6.4 trillion that were wiped out in a day.
Wow.
So real quick,
those are
it
big
doesn't just
numbers.
disappear. It goes to the people that sold before it dropped, right? Or how does it?
I think that's one of the biggest things.
Where does it go?
Of the stock market? It's just kind of confusing.
Where does that 6.4?
And we're going to hit on it a little bit, but just like understanding why prices fluctuate so much is still, to the normal investor, is just like a shot in the dark. I feel like a lot of times.
So where does it go? Is it like people that owned it at $100 and sold it at 95? That 5?
It doesn't go anywhere. It's just like a paper loss.
And it just stays. The company valuation is just less
people
or
that
more?
sell it, when it drops like that, then they actually lose money. But it's just like the value of real estate. If you don't sell it,
It just doesn't go anywhere.
Exactly.
And everybody that
Because
I
that's
know,
how those big companies are valued, is the market cap. How many shares are out there and what are the prices of those shares. And that's the value of the company.
All right, now we're going to get on to real estate, and most of these, in my opinion, are going to be our honest opinions of why real estate is better than the stock market, but we're going to try to be fair and go back and forth. The real estate is not for everybody, but I feel like it's more agile and more obtainable to understand and make money than the stock market in most cases.
Yep, I agree.
Cool. All right.
So in the stock market, it comes from stock price growth. So you buy it at $120 a share. It goes up to $125 a share. For each share you own, it goes up $5. So whatever that is, however long it takes that. So that is similar. I liken that to appreciation with the real estate world. You buy a house for 300 grand. The next year it's worth 310 grand, 330 grand, whatever it is, right? So that is very similar. All right. Real estate has cash flow. And I would liken that to the stock market's dividends that companies pay. Not all companies pay dividends, though.
Correct.
Some of the best companies in the world don't pay dividends. And those dividends are usually between, I would say, 1 and 4% on the very high. And there's some only dividend stocks out there that are 5, 6, 7, 8, but you don't get any appreciation with those. So that's just kind of how they're structured. So those are kind of the main returns that we're talking about here. And we'll talk about some other benefits of real estate has over that when it comes down to returns.
Those are the main two return avenues for the stock market. We're not going to get into like halving or anything like that. But in general, Lucas, for most stocks, and this is just trying to set the table. So if I have a stock that is $150 and it goes up to 155, do I get that growth and the dividends? Do I have to pick one or the other?
No, you get them both.
Okay, you get them both, except for certain stocks.
Yes, certain companies don't even give a dividend out. So when you go to buy shares of that company, you'll know what they give out, and they give that quarterly, and they can choose to change it or not give it to you as well. It doesn't happen very often, but they can choose to not pay out dividends.
I like it. And I think this is a good spot, Luke. So I'm reading through the rest of the notes. This is a good spot for two huge ones we can kind of get into, I think, is a little bit is buying into equity and then leverage a little bit. I don't see really. So the cool thing about real estate is you can, if you do it the right way, again, we're assuming you're a competent real estate investor and a competent stock investor. Unless you can predict the future, which no one can do, you can't really buy stocks at discount. And correct me if I'm wrong, real estate, you can buy at a discount. So technically,
enforce value
and create equity. Not even forcing value, but you can just sometimes get deals on it without even, I'm not even talking about forcing value. It's a separate thing. Just getting a real estate property that's worth $100,000 for $90,000.
Yeah.
You're building in 10% equity. Unless you can predict the future, you're not gonna be able to buy $100,000 worth of Apple stock for $90,000.
Yeah, or unless you're a freaking Warren Buffett at reading financials and can read
or
between
you
the
do
lines.
something illegal.
Yeah.
So you can buy at a discount when you buy real estate. You can't really do that at stocks. You can also force, like it's like you buying Apple, but then creating value and creating a new product for Apple. That's kind of what happens when you buy a real estate asset and rehab it. You're creating value with your what you're doing. So you're forcing equity. You can't do that in a company unless you own the company.
Yep.
I don't think we can understate the appreciation, which is value growth of a company. You can buy real estate at a discount. You can't do that at stocks, and you can create value with real estate. You can't do that with stocks. That's like a not a cash flow thing necessarily. That's more of like net worth thing. But those are huge advantages to real estate that I guess they're talked about, but those are that's millions of dollars potentially if you're going to be heavily investing in real estate, heavily investing in stock market that you can create. We have created millions that we would not have if we put all our money in the stock market.
Yeah, I agree, man. I think that's really good, very powerful. We do it every day. So you buy a stock, and honestly, you just hope for the best. You have zero say on the outcome of the value of that stock.
Correct.
Zero.
Not one. Even though they send you those things to go vote or whatever, you have zero say in that.
Zero say.
Yes.
And with real estate, you have more control over your future. Whether you want that control or not, that's up to you. But like Sam said, right when you buy it, you have control to force value right off the jump. And then as you hold on to that piece of real estate throughout its lifespan, you can affect the value as well by keeping up on maintenance and fixing the house up and taking care of your tenants and all that stuff. Just having some pride in ownership. Even though it's not your own home, we still have that pride in our rental properties, and that is going to help values increase maybe a little faster and a little more aggressive than the normal market would.
Yeah, 100%. So you can't control the real estate market. So I don't.
Right.
People are probably going to make that comparison. That's fine. Just like you can't control the stock market, but you can control. It's like you being able to control your specific stock and hedging and having more control over your specific stock ownership. You can do that with real estate because you can control your asset. And if it's a multifamily, you control the value with your net income. If it's single family, you can make it more valuable or less valuable by the things you do to it. Real estate is complex for sure, but I do think if you're comparing real estate to the stock market, real estate's a little more simpler. The inputs and what affects prices are a little more simpler. It's basically driven off of supply and demand of the houses and the values. Like the stocks are driven off of a lot of and things outside of that affect real estate values, but stocks are driven by a lot of speculation and a lot of what's going on here with interest rates have made this.
Elections can change stock prices.
And interest rates have made the real estate values go way up when they dropped them. But interest rates affect values, but that's supply and demand driven. It's what does the interest rates do to supply and demand? That's what actually drives it. If the demand is crazy high and interest rates are 8%, you're still going to sell. If demand's crazy low and the interest rates are 2%, you're not going to sell. So it all goes back to, I guess, what I was trying to get there before it cut out was supply and demand. All right, cool. So leverage is just huge. So you can, if you do it the right way, you can use none of your own money, which is an 8 that done fell over. That's infinite return.
Yeah.
You can get infinite return. There are ways to invest in real estate and hold long-term rental properties that allow you to get 100% ownership, 100% tax benefits, 100% cash flow, 100% everything all to you, and you don't even have to use any of your own money. It's called the Burrs method, and it's called leveraging other people's money to buy real estate. Not the topic of today's episode, but it's a very common thing that happens in the real estate space.
Yeah, it's beautiful. So we talked about putting 20% down, which is a great option to put your money. Still a beautiful option. You can go buy something on the market that's maybe you pay about retail, maybe you get a little bit of a discount, but it's ready to rent. You put 20% down, rent it out. If you're willing to put a little work into figuring out how to acquire properties at a discount, which is like the basis of real estate investing, then the infinite returns come into play. Mm-hmm. But you got to figure out a way to go acquire distressed properties, force that value, and be all in 80% of what that house is worth on the back end.
Thanks for watching. We appreciate it. Make sure to hit that like button, comment with something you learned, and make sure to subscribe to this channel. We give away more free advice on how to create wealth based on things we actually do every single day than any other channel on YouTube. Make sure to share this with a friend because our mission is to inspire you to think differently about freedom.